All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Khouri, financial planner, green thumb, husband, and just dad. I had a phone call this morning with a gentleman who had some money to invest. He had $500,000 of savings that he's worked very hard to build up over the years. And he wanted to invest it into something. And he was asking me, how should I invest my money, Michael? And as you can imagine, my answer was something along the lines of the fact that there is no one size fits all, and every person's circumstance is different. And we've booked a time to have a chat together. But it got me thinking, this is a great episode to record because it's a question I get a lot. Not everyone has $500,000, but someone can have some savings in place. But look, what do I do with this money? Is property best? Are shares best? Should I chuck it into super? Should I pay off my mortgage? What do I do with this money? And I've recorded similar episodes in the past, but I think it's great to have a refresher. And really, the first thing I want to say is it depends on your circumstance. What I recommend to one type of client that's in their 30s is going to be very different to what I recommend a couple that's in their 60s, for example. And it depends on that person's other assets and what they have as well. But to give you an idea as to what things we look at as advisors is first of all, we look at someone's strategy. We look at what their goals are. We start with that and we look at what an overall strategy is for them financially in their lives. And in that, we usually consider their debt. We consider their income, their savings. We look at what their goals are. We look at when they want to retire, how much they want to retire on. We look at their tax situation as well sometimes, and we weigh that up to work out, okay, what's going to be the most tax-effective way to manage all this. But really, one of the first things we look at is what someone's risk profile is. What are they comfortable with? How much risk are they comfortable taking? Now, we have several questions that we ask our clients, and we try to categorize. There's different profiles, and we have a discussion, and we work out, okay, this is how much risk they're comfortable taking, how much risk can they tolerate taking? How much are they willing to tolerate? Are they willing to be invested in something that's high risk, high return, or something that's low risk, low return? There's obviously pros and cons to both of those options. And as an example, someone could chuck $500,000 into cash, into a term deposit, and they have a particular rate that they would be earning every single year. Yes, you'd pay tax on that interest, but at least what you're earning is guaranteed. But it's not going to be a large amount usually. So that's something to consider when it comes to like a term deposit, for example. And usually they're over 1 year, 2 years, 3, 5, 7 years. Very rarely do I see anything over 5 years. And these days, very rarely can you even get something more than 2 or 3 years, depending on the bank, of course. The next part about it, another option to consider would be buying an investment property. And you could probably buy an investment property for cash if you found something for $500,000 and you've got the rent coming in, which is great. But the things to consider there is that, you're having to obviously deal with tenants, repairs, maintenance. That income, if you don't have a debt on that mortgage, the majority of that rent is probably going to be taxed because yes, you'll be able to claim some expenses like interest and repairs and maintenance and property management fees, etc. But that property is most likely going to be positively geared, and you're going to have to be paying tax on a lot of that, which is fine. There's nothing wrong with paying tax, but if there's other things that you could be doing with those funds, and if you've got debt in other areas, it might be worth looking at that and discussing that with your advisor or your accountant even to look at your tax situation, to just make sure that you're being as smart as possible. Another option is to put that money into shares, managed funds. Something where, yes, the disadvantage of that is that you can't touch and feel it. Of course, markets fluctuate. Markets don't always go up. But the advantage of it is that it's something which doesn't involve a tenant. It doesn't involve having to repairs and maintenance. It doesn't involve any maintenance on your end, as long as it's set up correctly, of course, and it's appropriate. Then you essentially would have an investment that's sitting there, and you don't really have to involve. You're not as involved in a managed fund or in a share portfolio as you would be with an investment property. Again, as long as you have the right advice and it's set up correctly, which is something you need to also be very careful of. The advantage of something like that compared to properties, as I said, there isn't as much, involvement. But the disadvantage of it is that you can't touch and feel it. Not everyone is comfortable having $500,000 in shares. Another example is superannuation. There are some great advantages to putting money into superannuation. There are also some disadvantages of putting money into superannuation. And there's the tax effectiveness of super that is very attractive to a lot of people. There's tax benefits putting money in. There's tax benefits while it's in there. There's tax benefits at retirement. But there are limits as to how much you can put in, when you can put it in. And this is where it helps to get good advice. But also, if someone's pretty young and they want to retire well before their 60s, then maybe putting all that into superannuation may not be the best option, because it's up until you turn 60, it's the conditions of release are very limited, and you can't just literally simply retire at the age of 40, for example, and start living off your super. Another example could be starting a business. Now, this can be a very smart idea if you have a business that you're buying or a business that you're setting up, which can earn you a significant amount of money, and that business, would increase in value, and potentially you could sell that business one day. But as you can imagine, there's a lot of involvement in having a business. It's very involved into what you need to do. There's the running of the business, there's working in the business, there's understanding the business. You can't just buy a business and hope and just assume it's going to be profitable. You need to make sure you're buying the right business and you're running it properly. Will it mean that you need to work less in your day-to-day job? Is it a financially viable idea to work less in your day-to-day job and to work more in the business? These are things that really need to be weighed up, but that could potentially be an option, especially if you have a really good business idea, or you think you'll do really well at something in particular, and you want to leave your 9 to 5 job. Another option is to put the money into something extremely risky, something which I'm not licensed to give advice on as an advisor, but cryptocurrency. That's something extremely risky. Many relate it to gambling. And again, you'll talk to friends that tell you, it's fine, it's safe. But it's something you need to be very careful of. You need to do a lot of research around. And most people will tell you that you shouldn't put anything in there that you expect to get back as well. Another option, and this is probably the last one that I'll go through, but another option is to have the money sitting in something like gold. You can buy gold physically, you can buy gold as an ETF, but essentially having it in something like that where you're obviously earning no income from it, but you've got the capital growth, and a lot of people feel comfortable with gold or precious metals in general. So these are things that someone can consider as well. But really, talking to any financial advisor, they're most likely going to tell you that the number one rule is diversification when it comes to investments, having different types of investments, investing into different areas. Nobody knows what the next big thing's going to be. Someone might have a inkling, they might have done some research to support that claim, but nobody has a crystal ball. And research has shown over the years that those that try to time the market usually get it wrong, and those that hold and think long-term are more likely to make more money than those that are real short-term investors. Again, unless you know what you're doing, it really helps to make sure that you have an overall strategy, and that you're not just doing things off the whim, because you might get lucky. You literally may not get lucky. You may get lucky, but there's a very big chance that you may not get lucky at all, in that you may not make the right decision. So I've gone through those points. I've gone through a few of the different things that someone can consider when wanting to invest funds, but you can tell that the real rule there is to look at your goals, to look at your circumstance, to diversify, to consider different things, and really, really understand your risk appetite, your risk profile, how much risk you're comfortable taking before deciding to just make a decision, instead of just making a quick decision, going with what you know best, or going with what Uncle Fred recommended on Sunday afternoon at the barbecue, or going with what you've done before, or going with what your parents have done before, or going with what you heard on Facebook. Really understanding your situation and really understanding what options have you got, what options are probably the most viable options, without having a crystal ball, of course, and just making sure that it suits your goals and your overall plan. Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases, and feel free to share this episode with any friends or family that you think it might benefit. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.